For the latest in strategic affairs, subscribe to our YouTube channel. Click the bell icon for more updates.
Did you know that the investment rate of the Chinese economy is a staggering 47%? The same number for India is 29%. Did you know the Chinese economy is estimated at $17 trillion, making it the second largest economy in the world after the United States? Hello and welcome to another edition of Capital Calculus. I'm your host, Anil Padmanabhan. For the last 2 years and more, China has been in the news for all the wrong reasons, especially after the West, once its keenest backer, initiated decoupling. Subsequent geopolitical developments has brought the country under greater global scrutiny. This, together with conscious policy choices and growing internal contradictions, has led to a dramatic decline in the rate of growth of the Chinese economy. In fact, the stock markets are very bearish about China's future. Some quarters even argue that a meltdown is imminent. What is the reality? To get a sense of the circumstances, we spoke to Shehzad Qazi, a guest on a previous episode of Capital Calculus and one of the most objective voices on China. Shehzad is a managing director of China Beige Book, which maintains the largest privately owned database on the Chinese economy. I began by asking Shehzad to share the latest data that China Beige Book just put out.
We've been incredibly counter-consensus all year on where the Chinese economy is headed. As some of your viewers may recall, at the beginning of the year, there was a lot of excitement, a lot of optimism around just how big the Chinese recovery would be in the aftermath of COVID lockdowns. The idea being that there's lots of pent-up demand in China, and so consumers are going to be rushing to book airline tickets and take vacations and buy expensive handbags and cars, and everything was going to come roaring back. And even the fact that the central government, now that it had let go of its zero COVID policy, would start doing fiscal stimulus measures. So you would have both organic growth kicking into high gear, and you would have stimulus-driven growth even driving the numbers higher. Now, we were incredibly opposed to this idea. We thought this was wildly unrealistic, both because Chinese pent-up demand we didn't think would be unleashed as rapidly and would be as big, simply because of the fact that Chinese consumers tend to be typically very conservative anyway. China doesn't really have a history of consumer-driven growth driving any economic recovery after a downturn. And of course, very importantly, the property market, which was the biggest store of wealth, if you will, for Chinese families, and then a store of investment. Well, the property market had taken a massive hit over the last couple of years. Household wealth, household savings had been essentially decimated, especially at the upper echelons of society, which would be the drivers of any big consumer boom in China. So that was one aspect of our thesis. We said, look, pent-up demand is going to be there, but it'll take a while for it to begin to show up in the numbers, and it may really be very modest all year long. And of course, that's what we've seen. That's what has played out. Number two, we were very opposed to the idea that there was going to be a big stimulus. We said, no, China is not going to just unleash stimulus. They're going to wait to see what organic growth looks like. And then when needed, they will step up with stimulus measures here and there, which is exactly what you've seen play out as well. Now, what happened over the rest of the year, starting, I would say, about March through the late summer, early fall, is as the economic data did not match up with people's wildly optimistic expectations, you saw that the market consensus took a turn for the negative, almost 180-degree turn, from ebullience all the way to downright pessimism and a massive historic market sell-off that has taken place in China. Once again, we find ourselves to be counter-consensus because now we are consistently telling folks, look, this is not a China collapse story. This is an unimpressive, lackluster recovery story. You're not about to have the Chinese economy just completely plummet. You are seeing sequential recovery throughout the course of the year. Q1 did look better than last Q4. Q2 looked better than Q1, and Q3 looked better than Q2. So property market is in trouble. We can talk about that. Manufacturing has held up a lot better than anybody expected. And consumer-driven growth, parts of it were very strong, but all around consumers have been cautious. So that's where the story has now landed in terms, when you look at it from the view of China Beige Book's proprietary large-scale data on the Chinese economy.
So, Shehzad, given the fact that there's so much of volatility in macroeconomics worldwide, not just about China, so this outlook that you just shared with us, will it hold up for the next 6 months, 1 year?
I think what we're going to see is that the pace of recovery that we saw up until about last quarter, more or less, and that we're seeing at presently, I think the conditions in the Chinese economy are more or less about as good as they'll probably get overall for a while. I think next year, when you look at growth levels next year, we certainly think that growth will be sub 5%. This year, the target was 5%. We think that they will, hit it. We think they'll hit it. Next year, they'll probably even set a target lower than 5%. So the pace of the recovery, the pace of China's economic growth is going to continue to slow. I think there might be some optimism eventually if property finds a floor, they can stabilize that. But there's just no guarantee of that. It's certainly not clear in the numbers that property is anywhere near finding a floor.
Interesting, because if you look at the policy outlook of the Chinese authorities, they reflect what you are positing before us, right? So which means they are now accepting that there is a new era of growth that China is facing, right?
That's exactly correct. I think one of the biggest misses when it comes to mainstream market commentators or China or what the investment banks have been writing all this time, and what's really behind a lot of these stimulus calls is a misunderstanding of the policy priorities of the Chinese authorities and the new economic model which they have come to sort of both accept or try to build towards. And number one is exactly what you said. They already understand now, and the party already understands that economic growth will slow no matter what we do. The returns on investment on the old model they've basically hit zero. And so the goal for them is no longer to have a high pace of growth, 6, 8%, whatever. They're not trying to do that. What they would like to see is a healthier, consumer-driven, more sustainable pace of growth if it's a low pace of growth, because what they're trying to avoid is getting to a place where they get 0% growth, 1% growth, at which point the economy begins to stagnate because they have failed to transition the economy towards something more sustainable, more consumer-driven, and so forth. So that's where the mind of the Chinese policymakers, which is why they're not rushing in to put stimulus in the economy. They're not rushing in to start reflating the property bubble. They chose to deflate the property bubble themselves. So you've got it absolutely correct.
So in your view, Shehzad, the zero or near zero growth, what are the prospects? And B, does China now really risk falling into the middle income trap?
Yeah, that's a massive risk for China. It's a country that is a developing country by most standards. It is not a rich country, but it is a country that is growing very rapidly. And the future of the Chinese population, there's a reason why they're encouraging women. Secretary Xi just 2 days ago, I believe, came out with a statement encouraging young women to have children and telling them that should be a priority for them. They are very focused on growing the population, the younger population, because it's a slow growing, it's a graying economy, and it's not a rich economy. So they may very well get stuck in the middle income trap if they're unable to put in the right policies in place and the right support measures in place. They very well could start seeing the stagnation. The idea that China would one day overtake the U.S. would seem laughably wrong at that point.
So, Shehzad, implicit in this policy pivot of the Chinese authorities is the move away from an investment-led growth to a consumption-led growth, right?
Exactly. Yes.
So how do How do you think this will play out, or rather, how will it be implemented, this pivot?
Yeah. So that pivot that they want to, that they're embarking upon, I believe that it is incredibly important for them to start paying attention to strengthening and stabilizing the private sector, the parts of the economy where you have innovation and parts of the economy that your labor force is increasingly in the urban areas being trained for. Everybody loves talking about the China youth unemployment problem, and it's a very big problem, and it's a problem that is set to get worse, not better, in the coming couple of years or so. You have a bunch of young graduates, coming out of universities with degrees in, what we would call white collar jobs in tech, in the legal field, and parts of the medical field, and engineering, et cetera, et cetera, et cetera. But the jobs are simply not there for them. And the reason the jobs are not there is because the private sector has continuously lost out at the expense. You've had the state sector, which has been bolstered in the last decade or so under President Xi, at the expense of the private sector, especially at the expense of the SMEs, which would typically be the backbone of the economy if you were focused on, becoming a modernized, innovative, an economy that drives innovation. So that is, I think, critical. And what that means more specifically is, in the Chinese case, access to credit. So not just more predictable regulatory policies, not just the state letting companies drive decisions in the best interest of the companies, in the best interest of the company, but not being sort of governed by political priorities, right? So you have to there's a fine balance in between making sure that firms in your economy are doing ultimately what's in the national interest, but not dominating and controlling their decisions because of political priorities, which is kind of the direction where China is going right now. But in any event, primarily it comes down to access to credit. And that is just simply not available. The private sector consistently, and more specifically, really SMEs, which would be the drivers of employment and which would ultimately help China transition, continuously losing out access to credit to large firms and state firms. They pay more than their large firm counterparts. They're rejected loans far more frequently. They borrow therefore at rates typically historically, corporate borrowing is much lower among them. So till they have that kind of policy support in place, they can grow, innovate, expand, and therefore incomes will, not rise because you're going to have a very serious employment problem on your hand, and the high-paying jobs are not going to be created. So it's all intertwined, and that's where it becomes very tricky because there's no guarantee that the Communist Party can succeed on this this ambition that they have of transitioning their economy.
So, Shehzad, what you're saying is that the role of state has grown dramatically within China in the last decade, and that needs to be walked back if you want to engage in this pivot.
Yeah, that's exactly correct. And again, more specifically, the idea should be to not throw good capital behind bad capital. Do not keep giving out loans to keep zombies alive, or to keep loss-making state firms alive, but to redirect it towards the companies, the entrepreneurs, the innovators who are actually going to be the drivers of the new economic model that the party cherishes now.
Shehzad, there is a macroeconomic paradox given the current state of China and the pivot they desire. So if you roll back investment and you want to step up consumption, great macroeconomic strategy. But problem is, minute I roll back investment, because the entire economy has been driven by investments, it is about like 47-48% is the investment rate prior to whatever we are seeing now. So if I roll that back, growth gets impacted. If growth gets impacted, incomes get impacted. So which means consumption will not grow, right? So how do they get out of this risk too?
Yeah, that's a great question. And that's where, primarily the role of stimulus comes in. And the question becomes, what kind of stimulus? So you don't just do stimulus, which is the old model, which they're not doing, right? So they've already stepped away from it. They're not doing big roadways and highways and big infrastructure projects. The most recently announced, for example, sovereign debt issuance of 1 trillion yuan, about 53 billion US dollars. It's focused on things like water conservation, flood damage control, So it's very targeted and specific type of infrastructure, investments that are taking place. It's not the old model. And similarly, of course, they're deflating the property bubble, which was a big chunk of that investment-led growth, also being undertaken by private developers, state developers too, and of course, driving local government finances to a large extent. Now, so what do you do? Well, first of all, is the point I made previously that you make capital available for those parts of the economy, the new economy firms in technology, for example. It's being done to a small extent, but not really at the large extent. And other businesses, other B2B industries, that you have, and so on and so forth. That's one. The second aspect, of course, is that if you do a rapid pullback, then the idea of doing more household-focused stimulus, the way we've seen in Western economies, predominantly the United States, becomes very important, because that's how you give households spending power when they may be getting crushed on the opposite side because of an economic downturn, or of course because there are massive layoffs in parts of the economy that are no longer benefiting from that old model. So the transition, so they are walking a tightrope. There's no question about it, because they also don't want to do household stimulus for whatever reason, and there are ways to fine tune that. And they're trying to pull back slowly from the investment-led model, and that's what makes China so interesting right now, because it's not totally clear how do you pull it off. So they are attempting something that probably has not been attempted by any other country. It's certainly not at this scale.
True. Actually, it's a big lesson for countries like India, which are now attempting a similar growth strategy of ramping up investment and improving productivity and growing. So there's a point, I think, where you need to, there's a tipping point beyond which this becomes self-defeating, right?
That's exactly right. For, developing countries or the global south or emerging markets, frontier markets, whatever label we all prefer, China is always seen as the shining example of what, especially in the post-colonial context, also what countries can accomplish economically, but there are very serious lessons now that they all have to take, that whereas there's this fetishization of an investment-led model of building the highways and roadways and infrastructure systems, which are very important, but that is not, going to be the be-all, end-all and the answer. That ultimately you have to be very cognizant about, not just educating the workforce, but making sure that jobs are being created in the right places so that your growth doesn't all of a sudden hit a speed bump, which kind of, in the minds of many people, and maybe even in some ways in reality, Chinese growth kind of hit a speed bump unexpectedly for almost everybody.
You heard Shehzad. At one level, he's categoric that China is unlikely to see the meltdown that is feared in some quarters. At another, he's very clear that China's economy faces serious risks, especially if it is unable to achieve the desired pivot away from an investment-led growth to one that is based on consumption. The downside risk of this is China falling into the classic middle-income trap. Clearly, this is a story which is very compelling and yet to play out. As they say, watch the space. Thank you for watching. Don't forget to subscribe to StratNewsGlobal on YouTube. Hit the bell icon so that you don't miss any updates. And please do share your thoughts, ideas and suggestions with us. I'm available on Twitter at Capital Calculus. I'll be back next week with another episode. Till then, stay safe.